So let's start. I think now it's 2 minutes after the deadline. We got time to start. So, as I said at the beginning, welcome everyone to this webinar. It's the idea is to clearly move through. I'm Cyril Bray. I'm CEO of my CB consulting and management company, and today your guest speaker, and I'm with Jocelyn. Jocelyn, let you introduce yourself.
Yeah, thank you, Cyril, and good afternoon or good morning, everybody. I'm Jocelyn Montpert. I'm the head of TDR, Trade Duty Refund. We'll get to talk about TDR a bit later in the presentation, but it's a duty mitigation company acting in the EU, the UK, and the US. Very happy to be part of that. And Cyril, thank you for inviting me.
My pleasure. So the idea of this webinar, as the title said, it's clearly said that this is the end of the de minimis within the European Union for low-value import goods, so goods below 150 euros, and the end of de minimis will be also accompanied by some other. We will see additional obligations and elements that we both with Jocelyn think it's really important for you to be aware of, and we will try to give you, let's say, guide you to the reforms, and we will try also to provide you some mitigations perspective and process that could for sure reduce drastically the exposure to the increase of the duties you will have to pay. Let's start. We'll try to keep it at the 45 minutes maximum, let's say, webinars, 5 key sections. So I will start with the openings, the numbers. Then we will talk with Jocelyn about the mechanics, how the new duty regime works. We'll talk about after the 3 levers, so the classification and everything. We'll get to the true cost models, what it's really behind what's one of the best mitigations many people talk about. And at the end, we will also, Jocelyn will told you about his company services, how it's work with the reforms, and we will also guide you to the checklist, what you need to know before the 1st of July. So, keep in mind that we will start talking about the specific things. 800,000, 13K. So it's clearly the maximum exposure you will see. That's the estimated annual exposure for a medium-sized cross-border branch shipping. It's based on some figures, so 5,000 orders per month, 65 euros per average order value, and a return percentage of 25%. Everything we will talk about are based on those assumptions, and we will have time to re-explain you how it's work. I just think that there is a small time lapse between the other one and the live returns. But anyway. On top of what I just explained you need to have that it's 4 important dates that reshape the cross-border economics. The first one, as we talk about, it's the 1st of July. So it's the exemption of the de minimis. As per 1st of July this year, you will be able to sell all your goods, import low value below 150, B2C, with a specific 3 euros per line items. In parallel, you will have also to see that as per November 1st, there will be an additional European handling fees, 2 euros, normally. This is not yet finalized, it's still under regulation, to be added per line and per item. So that means that potentially, for the example you show on screen, for 2 items, you may have to pay 10 euros per parcels. As per October 1st, the Commission will start reviewing the extension of the 3 euros to all imports under 150, including B2B. The idea is to clearly focus on any specific schemes that will avoid to pay the 3 euros. And the final goal to be achieved on July 1st, 2028 is the real added value tariff rates. So it should be clearly a replacement of the €3 flat fee customs duty by the clearly applicable ad valorem rate, like a regular import into the Europe. Jocelyn, now up to you.
Yes, Cyril, thank you. So if we get a little bit into the specifics and what is coming now, within 15 days or so, 1st of July in the EU, and the famous €3 that I think everybody has in mind. But really, the question is still in a lot of people's mind, €3 on what? What is going to be the basis for calculation? How is that going to be imposed and calculated on importation? There's a lot of rumors or assumptions, expectations that it's going to be €3 per parcel. This may come from different sources, probably handling fees that some countries have put in place. So some importers expect that they will just sort of multiply the number of parcels by three, and then come up with the number. That's not what's going to happen. What is going to happen is that the fee, the new duty, is going to be €3 per line of entry, so that we call here HS6 line. So if you combine two different items into one order, even into one parcel, then you will be hit by 2 times €3 because you will be importing two different HS codes. So that makes a big difference. On average, e-commerce brings 1.2 to 1.6 items per order, right? Depending on the type of e-commerce, but apparel usually is around these things. So that's typically, between 1 and 2. So it's it makes a difference, obviously, at the end of the day on the amount of duty that the importer will pay. So another thing that needs to be kept in mind and considered, which is not strictly linked to what's going to happen in July, because it's already the case, but I think it's important to remind that e-commerce, that is called in the EU distant sale, e-commerce importation requires that the customs value is the retail price, not the internal price, not the cost plus, not anything like this, just the retail price, which is typically the price that customs inspector will find on the website if they look for the item that is being imported. So again, that's not new, that's already in place, but there's still some misunderstanding sometimes, or even undervaluation that is linked to B2C into the EU that needs to really to be considered. Importing into the EU with lower price than, or lower cost of customs value than the retail value is still possible, but typically on B2B for intra transfer. Then in some cases, obviously, if it's not a sale, if it's not an e-commerce sale, then it's acceptable and it's compliant. But again, not in case of distant sale if the goods were already sold before they reach the EU. And sorry to be the bad news person at the moment, but also another thing to keep in mind, is better to know when to plan than not to know, is that there will be more fees and charges coming up in Europe, especially in November, when the handling fee, handling surcharge, will be introduced, and the date is the 1st of November. Here again, the handling fee will also be by HS code, by entry line, just like the €3 of duty. So here we put together some examples, calculation of the impact of import duty on low value plus the handling fee that is coming up. So this is how it will look after November 1st for low value e-com goods coming into the EU. So a couple of things that Cyril and I wanted you guys to keep in mind as we move forward. One is the classification audit, which is obviously a key component of any customs transaction. Make sure that the HS code classification is correct. When you think about it, today, for low value goods, what really matters is the value. Customs would look at the value of goods and make sure that if they are under 150 euros, then the value justifies it, and it's a real retail value. HS codes don't really matter really at the moment for low value goods. Now tomorrow it's going to be different. It's going to be the value plus the HS codes, because obviously the number of HS codes that you import will dictate how much you're going to pay for duties. So HS code classification should always be on top of mind and key, but even more that comes July 1st. The other thing is for our friends from the UK importing into the EU. There is, of course, there's a trade agreement between the EU post-Brexit, a trade agreement between the UA and the EU on preferential origin. So both countries or entities have decided to import duty-free goods that are either of UK origin or EU origin. So coming up after July, the e-commerce goods coming from the UK, even if they are of UK origin, will still be hit by the €3 if they are of low value, right? There is an exception of this. It's UK manufactured good, obviously, with H1 declaration and without IOSS. In that case, the €3 do not apply. But let's say a standard import declaration, H7 with IOSS, even if it's a fully certified UK manufactured good, the €3 will apply. So that's something obviously to keep in mind. So a few additional actions that we suggest you run between now and the 1st of July and possibly after as well. We talked about it on the previous slide. So obviously the classification has never been so important. Make sure that you can explain exactly what HS code is used for any of the goods that you import into the EU. Another thing to keep in mind, obviously, and remember the note that we made on the B2B import duty impact. So having an EU forward stocking, so having an inventory in the EU and bringing goods B2B from wherever you are to the EU can obviously be a solution, not necessarily the simplest and the fastest to do, but certainly something to consider and to avoid having single order importation into the EU. And then obviously the third point, as you understand, the SKU or HS6 consolidation is obviously going to have an impact on low value because that will significantly reduce the number of times you will have to pay for the €3 when you import goods into the EU.
Yeah, thank you, Jocelyn. I will try to deep dive what we call the EU forward stocking, so option 2. Why? Because in 6, there is no real debate about the potential savings you will generate with these options. But in the meantime, I will also explain you a little bit deeper what are the, let's say, attention points you need to know before moving to these solutions. Because again, each client case, each merchant case or manufacturer case needs to be analyzed case by case. There is no generalizations. We can give you some, let's say, way to improve or reduce the frictions of the duties, but you will need to do a personal analysis based on your current situation, the type of good you are selling. There is no specific, let's say, positions to be taken and to be recommended. We can only explain you what to do and what would be the positive one. Let's move forward. Forward stocking, so financial pictures. We'll see 3 different steps. So the first step should be the gross savings we may expect by applying this specific regime. The second one should be the real cost behind the scene, because most of the, let's say, people, speakers, experts, I can see also on LinkedIn and other, are talking about the savings, which is for sure the, let's say, first things to keep in mind. But beyond the reality, there is also some real cost and real exposures that you need to know before moving to these models. And at the end, we will do a net savings about the analysis. So, step 1. Let's try a simple example. That's the one we talked about at the beginning of the slide deck. What we call model A. So you ship directly from UK to the EU. You have 2 lines, so 2 specific HS code on your H7 declarations. You will pay €6, so €3 multiplied by 2. Then you got the handling fees as per November, which could add you €2 multiplied by 2 lines, so €4. So you will get €10 per parcel, low value parcel below 150, to be imported into the Europe. Then, as we said, we have a 25% returns volumes. So that means that on a full year basis, you will get 15,000 returns, and the average return price for your UK customs declarations, it's evaluated at, let's say, roughly around €10 at an average price. So it will represent you a €150 for returning your goods from Europe to the UK. But as you also use the return of your goods to be resale within the Europe, we take the assumption that roughly 70% of the goods that has been returned to UK should be resale also to other customer in Europe. And as we will explain a little bit later, you will see that there is no duty drawback on the €3. So that means that when you have paid one time the duties for the first import into Europe, then you re-import your goods in UK, but you will have to repay it when you resell it into the Europe back. There is no possibility to offset the 2-1. The total impact, it's almost, as I said, 813K euros per year. So it's really huge. Now moving to the model B. So model B, EU forward stocks. Very simple ones. You will have to import goods, but not one parcel per parcel. You will generate pallets, you will what we call bulk imports, and you will directly pay on the cost of goods sold, the COGS that you see on screen. Roughly for apparel, for fashion, it's 12%, the duty, like a regular ad valorem rate. So 12% of the goods estimated at roughly €18, it should be €2.16 per goods. You have also the TNC handling fee, which is a trusted importers, almost €0.5 per goods. And you have the EU return handling fees also, almost €2. There is no duty on EU resale because in fact your good has been imported, has been delivered to the market within the European Union, and then it's just you'd still have to pay for sure the VAT via the OSS scheme or via another scheme, depending what you want to apply, but that's all. The total estimated yearly value, it's estimated at 160,000 euros per year. So it's not really difficult to do the maths and to see which regime is the most attractive one from a financial cost point of view. Now just try to deep dive this analysis. What the headline savings doesn't include. That's clearly what I want to show you and explain you a little bit, because that's clearly where, let's say, the pictures become a little bit more complex than the one we are just describe and explain at the first one. Firstly, as you can for sure understand, if you have a stock, you need to have also a warehouse and a logistic attached to import your goods, store it, repackage it. You have also inbound handling. You have also working capital cost linked to the fact that you need to immobilize your stocks within the European Union. You need also to get a specific insurance. You need some shrinkage. So roughly the estimations for a stock of 5,000 parcels per month to be sold, we estimate a yearly fee between 80K to 155K. So that's our own estimations, for sure, depending about the type of storage or warehouse you may use and the type of goods and insurance you may have. It could be below, it could be above this threshold. On top, you need also to have tax and customs compliance cost. What it means? It means that if you need to register your company within the European Union to store your goods, as Jocelyn explained you, when you move your stock from UK to Europe, it's a transfer of stock. It's not a sale of goods. It's not a retail of goods. It's only a stock transfer, but stock transfer from a VAT point of view, it's also considered as the same type of operation that's a sale. So you need to have a VAT number in the destination country where you have your warehouse located, or where you rent some facilities into a warehouse third party. And then after, you will have to do the OS filing. So the one-stop shop apply in force within the European Union since July 2021. It's almost considered between 5 to 11K per year to do that. As the UK is not part anymore of the European Union, you may need also in certain countries to appoint a fiscal representative. A fiscal representative, it's a company that will represent you for tax purposes within the country where you will declare your stock, and when you will declare your OSS regime. Those costs are expected to be between 2 to 6K yearly. And at the end, you will need also a specific bulk import custom declarations to be managed by your custom brokers. Could be also sometimes a warehouse manager. All those costs together are estimated between 9 to 22K per year. And last but not least is the custom valuation risk, like Jocelyn explained you before. What does it mean in practice? You need to have a transfer pricing documentations, because in fact you will have to explain why you move your stock and what's the value of which you move your stock. So if you move your stock at reserve price, there is no real transfer pricing documentation needed, except the ones that you have a specific business model to be explained. If you move your stock at a certain value, cost of goods sold, which is different from the retail price, you will need to have a specific customs documentations linked to transfer price to explain why you will move it at a different price that you will resell it within the European Union. And this customs documentation, in fact, it's clearly something that should be audited by the customs authorities of the destination countries. So you need also to have some post-clearance audits. You need to have a lot of other things. And in many things, you will have to take care about this formality. You cannot avoid them. All things are expected to be between 8 to 30K. Let's try to keep the forward-thinking models with the real numbers. So you will see what's going on, what are the savings, what are the potential, let's say, other additional costs you need to consider. So we got the duty plus handling savings, which are estimated around 600K per year. The slides that I explained you at the beginning. You got the return cost savings also, which are estimated around 213K. So the gross savings, as we start with the beginning, could be around 813K per year. These gross savings should be reduced by all the costs I just explained you in previous slide. So if you take the average of 150K up to 80K for warehousing, tax compliance 22 to 9K, custom valuation 33 to 8K, it's clearly something that will reduce your total gain from 813K till benefits. Smallest one should be at 610, highest one should be 750. So you see that you need to take into consideration that it could be 200K of differences between the two ones, between the real gross saving you would see on screen and the final one you would set. In terms of break-evens, which is also something to give into considerations, we estimate between 3 to 5 months, depending about all your activity, if there is any seasonality, within your activity or not, to reach the break-even position. In practice, that means that after 3 to 5 months, moving to forward stocking solutions will become to be beneficial for you and profitable. If you think about only using it for a certain period of time during the year, maybe let's say only for peak season, for example, you say, okay, I will have a stock for my peak season of 3 months. If your peak season, I don't know, could be before summer or within summer or at the year end, it maybe make no real sense to create this sort of model if it's only for a very limited number of months. If it's a long-term or at least 1 year one, it could make sense to have one. The 3 risks that no one really alerts you on, let's say, specific posts or social networks. There are 3 structural risks for forward stocking. The first one, as we start talking about it, is the custom valuation on cost of goods sold. As Jocelyn explained you before, the intra-group stock transfer is different from sales. So as it's not considered as a sale from the UCC, so the Union Code, Customs Code, there is no transaction value to report. There is no sales. It's a stock transfer between your legal entity in UK and your, let's say, registrations, tax registrations within European Union. So you will have to move what we call to Article 74 of the UCC, which say all fallback solutions to determine the customs valuation. So there is a lot of potential methods to be used, but mainly the potential one should be not so far from the retail price. So that's why when we said COGS, we need to take into consideration this limitation by law. You may have also some mitigation via what we call commissioner agreement and specific ruling before first import. That means that you may have to contact the authorities in destination countries and ask for a binding ruling to get your valuation method validated before the first import. First one is the customs warehouse, which is different from free circulations. Many people say, oh yeah, you need just to import your goods within a customs warehouse, so bonded warehouse. When you import your goods into a bonded warehouse, this is not possible for B2C sales normally. So you cannot use a bonded warehouse to deliver goods directly after to a private seller within the European Union. It must be first released to free circulation. That's something really specific, and that's something which has been highlighted by the European guidance and the reforms and Article 3.22. And the last one is the anti-abuse clause called Article 243 of the UCC. In fact, that's what does it mean in practice? That customs can reclassify a bulk H1 import as a series of distant sales. Why this article has been created for is that many, let's say, distant sellers think, okay, to avoid paying the €3 per distant sales, I will create a bulk shipment with all my small parcels combined into a pallet, and then I will say it's in H1 imports. Then with this H1 import, I will only pay import duty, if any applicable, on the global value of the pallets, not one by one. So I will avoid the €3. But if the customs authority, by controlling or by doing some screening, determines that you are trying to achieve this, they will requalify all your bulk import as many small distant sale imports, and you will have to pay the €3 plus some penalties and additional things. Do not also forget that, for example, in France, customs regulations, it's also linked to criminal aspect. So you may have to, let's say, pay potentially some penalties, but you may have also to pay to get some criminal exposure too. Jocelyn, up to you.
Yes, thank you, Cyril, and thank you for the explanation on the situation. Yeah, just a few words about TDR. Like I mentioned in my intro words, TDR is a duty mitigation company, and what we've done here is we've listed what we most commonly do for our customers. So you can see the duty-free returns. In the UK and the EU, it's called the returns good relief process. But it also applied to the US. So it's basically the fact that you can return goods duty free and VAT free where there is VAT. If these goods were originally exported from your territory and return without being used, right? So in e-commerce, obviously that happens very often in cross-border e-commerce, at least, and we help retailers with that. Another one, which is the duty drawback, which is very much a US terminology, but we keep it for the UK and the EU as well, just for convenience. The duty drawback is the ability of recovering duties paid on import on goods that are being returned. So it's very much linked to the same situation or same model as duty-free returns, except that it's on the other side of the transaction. Duty drawback is where you paid duty in the first place when you imported the goods. So it is a very well-known solution in the US, a little bit less known in the UK, and it's a solution that we put in the market very lately in 2025, early 2025, in the EU as well. And that's obviously a very impactful solution. Also, maybe worth mentioning that nobody needs clearance in isolation. Usually, if you need clearance because you move goods and you sold goods, so you also need a carrier. You also need logistics services, and we're very mindful of that. So we integrate with some express carriers. We integrate with some return providers, and we'll be very happy to connect you with our great partners. If you wanted to. And then last but not least, and obviously with the great support of Cyril, we also provide customs consulting in the EU, in the UK, in the US for all these great topics that are very dynamic these days and require a lot of attention. So on all these things, we love to support our customers, retailers for the most part, e-commerce merchants mainly. So that's about TDR. Thank you, Cyril.
Yeah, thank you so much, Jocelyn. Just want here to highlight one point because Jocelyn don't really insist on this one, but I think from my own and from my knowledge, it's something quite unique that TDR is proposing. It's the duty drawback within the European Union, which is something really, let's say, exceptional, because normally there is no centralization of duty drawback within the European Union. So you will have normally to, let's say, submit any claim for any departure countries. And it's really complex, as you may have a single point of entry within the European Union. And with TDRs, they find, or let's say, the solutions to be able to do it at European Union level. So that means that if you want to work with them, you may be able to recover duty paid within the European Union, which is something really important. And I just want to highlight it before moving forward.
Thank you, Cyril.
My pleasure. So what you need to do now and before 1st of July, for sure, it's the collections of H7 IOSS. As you know, €3 per declaration line. Work on your HS code classification for sure, thread descriptions, everything. HSCs from post, if you use the postal networks, you will have also to pay €3 per declaration line. Could be collected by the postal carriers, but in reality, you need also sometimes to collect it yourself if you sell DDP. H1 standard, as Jocelyn explained, you need also to pay €3 per toric sublines. So in fact, in reality, you will have to pay €3 in many cases for each declaration line. An important thing that I assume you need to know, or maybe you already know, is the specific product identifier obligation that has been created and which will be enforced as per November 1st this year. So on top of the handling fees of €2, you need also to ensure that you, as merchants, needs to have a specific product identifier, PYD, for each good you will sell to the European Union. This information could be provided to your carrier and customs broker as per July 1st. It's a voluntary, let's say, providing at the beginning, but as per November 1st, it will become mandatory things. In practice, that means that if you will have to work on your product catalogs, ensure that everything should be, let's say, on place, and that each article should have a specific number of mandatory mentions to be added to your product catalog. Incorrect or missing PYD, that should be put a declaration error, and then that means that your goods should be not custom cleared and should be stuck at the borders. Many carriers, many brokers are starting talking about it, doing a lot of webinars and everything to inform you how it works. So I will clearly recommend to link with your custom brokers and with your carriers to know how they will manage it. And in parallel, we stay at your disposal to discuss this point and to support you how to build the product identifiers and how to work for it. Again, it's a real change, and you will have to clearly take care of this, because without this information, you will be stuck at the borders. And to conclude, just a quick checklist of what you need to do before July 1st. It's more a sort of, let's say, reminder of what we explained to you. So immediately what we said, it's need to assess what's my model, business model. Check your P&L exposures, check your AOV orders, check your HSC's distribution list. This is not generic, as I already explained. It's surely a case-by-case analysis. In the meantime, audit your HS6 classifications. Are you your own product manager or your own manufacturer? Are you a retailer of famous brands? In that case, you may use for sure the HS6 classifications that famous brand or let's say manufacturer has provided to you. But sometimes it's good to do an audit and try to see how it works. Also, it's also interesting from my point of view to review your audit, your HSS classification tool you may use, because sometimes you may use classification tools which are really interesting. It could be with AI, it could be with a lot of things. There are a lot of providers in this area, but some are really good, some are not so good. So I clearly also insist to review the system and the process you are currently using. From a strategic point of view, as I explained you, evaluate the forward stocking options. It's a fully cost one. So it could be also including a lot of things to set up customs warehouse and a lot of other registration things for tax and everything in Europe. Think about potentially few months. So if you want to move now, you are almost late, but this is not the end. You can start initiating everything and then you may be ready to move at maybe September or October this year. From a legal point of view, also structure your custom valuation before import goals. That's exactly what I told. Do you want to import with COGS? Do you want to import with another one? You need to think about also potential distributor agreement within the European Union. So there is a lot of things to be done there. And at the end, strategically, trade up or absorb. That's clearly how to choose your pricing strategy. Maybe it could be interesting to prioritize order above 150 euros just to avoid the 3 euros and to move to the H1 ad valorem declaration. Why? Because sometimes if you say, okay, maybe to ship to the EU, my average order value is, I don't know, 120, I'm not so far from the 150. So if I oblige my customer to buy 150, I will potentially lose some conversion of sales, but in the meantime, I will maybe have some gain in terms of order deliveries and additional costs linked to. So it's some things to keep in mind and to also discuss within your maybe logistic department and also financial one. So thank you so much for attending this webinar. Jocelyn and myself stay at your disposal if you are any questions. I'm not sure to see any question right now, but feel free to write your question within the chat and we may have a possibility to look at it and to answer it. If it's not really easier or if you don't have, let's say, or if you don't want to raise your question directly within the chat, feel free to DM myself or Jocelyn, and we will be more than happy to answer your questions or to discuss with you with your current project.
Certainly.
All right, so do not see any questions. So thank you all for your time, for your and for assisting this webinar. Thank you, Jocelyn, for also being there with me and to co-present this one. It was really interesting to discuss together, and I hope that we get interesting informations. And as I said, we are all at your disposal to discuss more deeply these topics.
Thank you, Cyril, and thank you, everybody.
Thank you. Bye-bye.
Bye-bye.